fundsupermart.com.
Hello everyone, with us today is Mark Redfearn, Managing Director of the Public Fixed Income Team at Eastspring Investments. He will share with us his views on the European debt crisis and outlook for US investment-grade bonds. What do you expect to be the end result of the European debt crisis?
Well, I think the end result for the European crisis is actually a breakup of the euro. What we see at this point in time is too much hope is being placed on an outcome that's favorable for markets. And what we really think needs to happen is when we look at the Greek economy, when we look at Spain or Italy, we recognize that those countries need their own currency. And they need their own currency to devalue itself so that they can be competitive against the German economy. So what we think will happen is markets continue to be disappointed. We have another European meeting tomorrow. We think markets are expecting too much of an outcome there. We just don't think German taxpayers will continuously fund underperforming, unproductive countries such as Southern European countries.
How would US investment-grade bonds benefit from this crisis?
Well, we've already seen a number of inquiries come through our office, firsthand from European banks and some European insurers who are trying to get out of Europe from an investment standpoint. We think the US economy, along with US balance sheets in terms of corporate balance sheets, really have probably improved much more than their European counterparts. So whereas the financial crisis motivated a lot of companies to build liquidity, the Europeans have been very slow to do that. And they now find themselves in a situation where there's not enough growth to grow their way out of a problem. And so further austerity there will simply cut growth to a larger degree.
What are the other supporting factors for US investment-grade bonds?
Well, as I mentioned, the US balance sheets are in very good shape. And when we look at kind of the stable metrics in terms of leverage at 2.1 times in the US for corporates, we look at cash on the balance sheet as a very strong indicator of liquidity. And we look at debt service is at an all-time high in terms of affordability for corporations. So we really think that US corporates, as a reflection of a defensive position in the marketplace, really will capture investor interest with regards to the core principle of preserving capital, principal preservation. I know a lot of investors want to talk about the upside of certain asset classes, but in fixed income, the best we can do as investors is simply get the money back with a timely coupon. So we think it's more important right now, with so much uncertainty, really to focus on the downside, and that's where the stability of fixed income will be favorable.
How would the latest Operation Twist extension affect the performance of US investment-grade bonds?
Well, we get a lot of inquiries with regards to interest rate levels and what our target is. And it's been a very difficult period to forecast because there's been an inordinate amount of central bank intervention. In the US in particular, Operation Twist has resulted in the Fed purchasing almost half of the duration or half of the maturity structure of US Treasuries just in 2012. So we think that rates will probably remain low. The Fed and other central banks really are quite focused or desperate to keep rates low in order to help financing at the consumer level. So I think Operation Twist actually will continue to keep rates low over the foreseeable future.
How much room is there for spread to further tighten?
Well, I think spreads can tighten in an environment that's more stable. We've taken a certain defensive position in the portfolios in terms of moving off of a bullish position in the first quarter. So as we've taken risk off of the portfolio, we want to have more latitude or leeway to put on risk at points of dislocation. And certainly, as I mentioned, our outlook in Europe is more bearish maybe than the market. But we think US corporates can benefit over time due to the stability. Again, we think there's a lot of volatility, and we think the downside protection that one gets through corporate bonds, especially in terms of an income stream, we think those attributes are very favorable.
What are the risk factors investing in US investment-grade bonds now?
Yeah, the risk seems to be more macro. When we look at global growth, we acknowledge that the US is in a very slow pattern. It appears that China may have some growth concerns, and clearly Europe is not able to pull itself out of a very slow recession. So there's no one predominant region in the world that can help offset some of these challenges. And so as the globe has to focus on austerity from a sovereign level, that's going to reduce growth further. So I think as we look at markets and we look at risk assets today, one of our concerns is the correlation of risk assets continues to grow, continues to move towards one. And we don't think that bodes well for risk taking. So even though the US may be more stable, it may be disadvantaged from a principal standpoint if we face another kind of global fiscal crisis.
What about if risk aversion comes down?
The risk aversion? If risk aversion comes down, we think spreads can do better as well. So it's really a discussion about asset class and how you look at a portfolio. It's not as simple a binary question in terms of do I want to be in fixed income or do I want to be in, say, something like equities. We think there's always a natural percentage that should be allocated to some safety. We think that safety net could be higher today than most investors have. We've seen about $1 trillion come into US fixed income over the last 3 years, and we think that's a long-term asset allocation change. So we think corporates are the preferred, more stable investment that offers materially higher yield than treasuries.